Welcome back in this series of videos of microeconomics. My name is Revi, and today I want to give you an exam checklist. So, if you're doing an insurance exam where part of the exam will be on insurance, here are the things that I found to be the most commonly examined points that every student ought to know before they enter an exam on uncertainty. So the first thing is that you ought to know what is a risk averse, and you ought to be able to define it in words. You ought to be able to see it graphically. If you look at some of my videos, you will see that a risk averse individual can be equivalently defined in three ways. You ought to know what is a certainty equivalent for a risk averse individual. So you're able to reduce lotteries to single numbers. So that's the certainty equivalent. And you ought to be able to do the optimality conditions and solve for the optimal insurance, for example, that a risk averse individual will choose. You should be comfortable with drawing uncertain outcomes, right? So the way that we draw uncertain outcomes is through graphs. So good outcomes versus bad outcomes. So effectively, even though the nature is going to have only one good, you can use the two state diagrams to represent. You should know and understand that the risk-averse individual will fully insure under actuarially fair insurance. And it's quite often the case that you'll be given an exam question where you're asked to show that a risk-averse individual will fully insure. And you should know generally why a risk-averse individual should fully insure. You should also know that a risk-averse individual will not fully insure under actuarially unfair prices if he has the choice of how many units to buy of insurance. So a risk-averse individual might fully insure at actuarially unfair prices if that is the only option, if it's a take it or leave it off option of either being on full insurance or not being on full insurance. And then the final bit where it gets a little bit more complex is where you have different types of individuals. And then we want to think about what is an equilibrium. If you don't remember what an equilibrium is, make sure that you understand that in insurance problem, an equilibrium means no one has an incentive to unilaterally deviate. And the agents that you need to consider is the insurance firms that are currently in the market, the insurance firms that are out of the market and they're rationally deciding not to enter the market, and the two different types of buyers. And you ought to be able, with a graph, through your understanding of cream scheming, show that a pooling equilibrium does not exist and understand what a pooling equilibrium is. Right? And finally, you have to show when a separating equilibrium exists, and you ought to be able to draw fairly quickly the separating equilibria and how it looks. So if you have all of this under your belt, that means that you're ready to take this part of the exam. Of course, practice through past papers and through questions, but think of this as a little checklist that you can go over to see how well you've covered the key ideas in insurance markets. I hope this helps, and I'll see you on the next video.